speak to Mr. Bharat Madan, who is the whole-time director and CFO at Escorts. Thank you so much, sir, for joining us. Good morning to you. This is Cheryl on the other side. And let's talk about the domestic tractor industry, because you're expecting it to grow in the mid to high single digits. If you could help us understand which regions will likely help contribute to this sort of a growth going ahead, as well as can we expect your company to go ahead and outperform the industry, or the growth will be in line?
Sure. So thanks for calling and good morning, everyone. I think as you mentioned, so we had already guided for the industry to grow in the mid to high single digit this year. And I think this has come on the back of the prediction for average, normal to above average, above normal monsoon, which is likely again this year. This is the second year in succession now. I think as we have seen in the last year also, the market, especially in the southern and western regions, which are more dependent on rains for irrigation, they outperform the industry, and we expect the similar trend will be there this year too. And we will see the more growth coming in from the southern and western market, if we get a good distribution of rainfall in these regions. So I think as respect of Escorts is concerned, so obviously we are also expecting we'll grow in line with the industry, and maybe, as you know, our focus more is markets are more stronger in the northern and the central Indian region, where the growth has been slightly lower than the overall growth, what we've seen in the southern and western markets. So that's why we saw some pressure on the market share last year. But this year we got good product portfolio, and we got done some new launches in the end of last year. And there's some more launches planned in this year, which will also cater to the southern and western market, in a good way. So we expect we should be able to gain market share in those regions, starting with these product launches, and we should be able to do better than industry.
Sure, Mr. Madan. Hi, morning. Thanks so much for joining us. You did speak about market share gains in your export segment, but what about the domestic front of the business? What kind of market share gains are you targeting for the domestic market?
Yeah, so I was talking about domestic only, not about export.
All right, so my bad on that part, but help us understand for Q4FY25 in terms of your overall geographies, where are you targeting? And then also in Q4 non-tractor business, if we talk about that, your sales have contributed 21% of revenue versus 18% in Q4. How can we see the balance of these segments going ahead, and where can we see this number headed?
So the non-tractor segment, so I think other than tractor, we also got other farm equipment. So as you know, the Kubota business now, which is merged into Escorts, and they are a large player in the harvester side, so the combined harvester and rice transplanter. So they got a very good market share, and that's the business which has done very well last year, and we expect a similar trend will be there this year too, on the back of a good monsoon, especially in the southern and the eastern market, which are more paddy areas. So where we sell these harvesters. So we expect the similar growth momentum will continue this year too. So non-tractor segment will continue to also show decent growth now. So this comprises our engine business for the power sector, the farm equipment segment, and also spare parts and service income which comes from there, and which have been doing very well. So I think the numbers will continue to grow, but now this year, since we're also looking at tractor industry to do well, so maybe the numbers may remain in the similar range, what we're seeing last year.
So what does actually all of this actually mean for your margins going ahead? Are you expecting the margins to be in this tight, narrow range, or is there some sort of a price hike that you are looking at from these levels that will actually then change the way how the margins will look?
So we've already taken a price increase from 1st of May this year. Even though it's a nominal price increase, so it's up to 1% depending on product categories. From model to model it varies. And as of now, we are looking at the commodity prices, which are continue to be soft, which has helped us in improving margin in the last quarter too. And the similar trend looks like is continuing even now. So if the same trend continues, we may look at some benefit of operating leverage to also come in, and maybe slightly better margins compared to last year. But having said that, obviously a lot will depend on how the movement happens on the commodity side. Because if the pressure continues to build up, if there's a good demand, and the pressure really, strengthens, then obviously there'll be a issue, and maybe we have to pass it on to the market, maybe with a lag. So that normally has an adverse impact on the margin. But as of now, the outlook looks positive, and the commodity price looks soft for the year.
I just wanted to come on a follow-up on that particular front, because you have a lot of commentary coming in on your margins when you look at what analysts are saying, and they're saying near term the pressure, there could be some pressure on the margins on the back of that you have a subsidiary amalgamation. But do you think that that will be a concern that one should have in mind, or it's fine and you will be able to maintain your margins and also, in fact, better going ahead?
So the merger has already happened. So the dilution in margin which was expected is already priced in now. So it's already there in the last year numbers too. So that's only the bottom side. I think we can say where we hit the margin now. So it's only look at the upside now from here onwards. We'll only look at improvement coming in on the margin as you integrate the business to the merged entities and you see looking at the cost going down. So that will only help in in the margin improvement going forward. So I don't think there will be any possibility of margin going down from this level where we are already today.
Okay, and also, Mr. Madan, help us understand what's your order book shaping up to be like? What's the orders that are already in the pipeline? If you could give us a sense on that.
We don't track the orders in the agri business and construction equipment business. It's only the railway business where the order book normally is maintained. There is mostly tender-based orders, where you keep getting it. And railway is already sitting on one of the highest level of order book today. It's more than 1,000 crores. So I think I'm sure that business will continue to do well.
And lastly, help us get some sense on your capex plans. We know you are looking for land acquisition. Your capex for FY26 is planned at around 350 to 400 crores. Help us understand, how do you plan to fund this? Is this all from internal accruals, or are you going to be taking over some debt?
So this will be all funded by internal accruals.
Okay.
So if you look at even last year's cash flow or free cash even after meeting the capex was almost 1,000 crores. And this year we expect the similar cash flow generation will be there. So we don't expect any borrowing required for that. We got enough liquidity on the balance sheet. Even the internal accrual for this year are more than enough to pay for this capex.
All right, sir. Then we leave it there. Thank you so much for joining us on ET Now to talk about the way forward going in for Escorts Kubota, and all the very best for the new financial year, that is FY26. Thank you so much for joining us.